Hi everyone, so we are in chapter 10 and we are looking at purchases. So there are two types of inventory systems, and depending on which inventory system we are using, we have different journal entries. So the inventory systems, we have periodic, and then over here we have what is called perpetual. Okay, so the first part of the book comes in and uses periodic. And when we look at this, there's going to essentially be a main type of formula. It's beginning inventory. And we're going to add in any purchases. And we're going to add in any freight. All of that gives us, oh no, where'd it go? My whiteboard disappeared on me. There we go. All of that gives us available for sale. Okay, so I'm trying this new whiteboard thing and it's taking a little bit of practice, but we're getting there. So once we have all of this available for sale, we come in and subtract out what is ending inventory. And that is going to give us what we call cost of goods sold. So cost of goods sold, we're going to abbreviate it COGS. It's essentially all the items that we sold during the year. We take inventory counts just periodically throughout. Versus perpetual is when you continuously keep up with it. So we're going to talk about periodic first. These new accounts that we have, purchases and freight, those are going to be essentially our fives. They are like expense accounts, but your book is going to call them cost accounts. But they are treated like expenses. That's a bad S, so cost. So when you increase a cost account, that means it's going to be a debit. And when you decrease a cost account, that means it's going to be a credit. Now, when you guys go in and buy something from a vendor, remember, we're from the company's standpoint. So when we buy something from a vendor that we are going to turn around and resell, sometimes we have goods that are damaged or we just don't like them. They don't come in the way we think, and we have to return them. So now we're going to have purchase, returns, and allowances. And that is going to be called a contra cost account. So a contra cost account means it's going to do the opposite of what you have up here with the cost accounts. So if cost accounts increase with a debit, then contra cost accounts increase with a credit, and vice versa. If you need to decrease a cost account, it's a credit. So for the contra, a decrease would be a debit. So this makes sense because if you bought something, you came up here and made a debit on the journal entry. And now if we need to return it, instead of affecting the purchase account, we're going to do purchase returns and allowances, and that would be a credit. The other account we're going to have is purchase discounts. So purchase discounts also is a contra account, so it's going to work the same as purchase returns and allowances and do the opposite. So just like chapter 9, where we had sales returns and allowances and sales discounts, now on the flip side, we have purchase returns and allowances and purchase discounts. So when we come in and do these inventory journal entries, when we make purchases under the periodic system, we are going to have some new accounts involved. The other thing, let's erase perpetual right now. I'm going to hold off on that for a minute. And The other thing we have is freight. So freight is also considered a cost account. When we purchase freight as on our products, it's going to go in as a debit. Very rarely will you have to credit it, usually just in your closing entries. So there's some type of freight. We have what is called free on board. That's what FOB. And you can have shipping point, or you can have destination. And that would also be free on board. So FOB shipping point. It is going to be a title transfer at the seller's dock. So at the seller's dock, title transfers. And the buyer is responsible for getting the shipping to their location. At FOB destination, title transfers at buyer's place or at the destination that they ship it to. And therefore, the seller is responsible for getting the goods to the buyer's destination. So when you come into this, what it affects journal entries is who's responsible for paying the shipping. So if it's destination, we as a buyer don't have to worry about shipping costs. If it's FOB shipping point, then we as a buyer do have to worry about shipping costs. And that comes into effect especially on purchase discounts. Shipping is not included on discounts. So when you go in and calculate it, you cannot use those numbers to calculate your discounts. They have to be just on the purchase amount. So just on that amount, it gets the discount. Okay, so let's go in and do some example journal entries. I'm going to clear all of that. And let's go in and say we are going to purchase $1,000 of goods. So we've got $1,000. And let's say our terms are 2, 10, net 30. So same way you read discount terms, we get a 2% discount if we pay within 10 days. If not, the net amount of the invoice is due in 30. So today is date-wise January 26th. So let's go in and make our journal entry for the purchase of those goods. So when we purchase them on 1/26, we are going to debit our purchase account because we are increasing it for $1,000. And let's say we bought it on account, so it's going to be accounts payable, AP there, accounts payable for whoever. Let's just say we bought it from Mr. Ferguson. So we're going to put that for $1,000. Now, if we come in and assume this is FOB shipping point, we may have to buy or get FedEx or somebody to pay shipping. So let's say shipping is $50. We can either have this paid directly to FedEx, and if we did that, it would be freight in, and it may be $50. And you have to watch how you're paying freight. You could pay cash or it could be AP. Either one, but essentially you're doing $50. Now the other option you can have, I'm going to put this over here, the seller could come in and say, we'll pay the freight for you and add it to your invoice. So if that happens, you got a purchase of, oh, not 50. Let me erase that. Let's erase that one. So we got a purchase of 1,000. We've got freight of 50, and we have accounts payable for Ferguson of 1,050. So those are the ways you can have it. Either you separate it out and because you pay the freight company individually, or it's all in one journal entry. So let's come in and say we are going to make payment on January 31st. Now, remember, you have to watch your dates here. We get a 2% discount if we pay it in 10 days. If we bought it on the 26th, are we within our 10 days on the 31st? Yes. So we're going to get a 2% discount on the $1,000, not the $1,050, just the 1,000. So when we come in and make that journal entry, you got to remember we're paying off the goods. So if we're doing it like this first entry here, we would come in and do accounts payable. Whatever it went on the books is what it's got to come off the books for. So there's accounts payable for 1,000. We're going to come in and do a credit to purchase discount, and you would say 1,000 times 2% would be $20, and then we're going to pay cash, and we're going to pay $980 cash to Ferguson. Now, if it was this journal entry where the seller incorporated the shipping in their cost, on 131, we would come in and still do accounts payable, but we're going to put 1,050 there as accounts payable because that's what we have it on the books for. Our purchase discount would still be $20 because it's only 2% of 1,000, and then our cash is the difference between the 1,050 and the 20. So you got to remember you got that extra $50 in shipping, so it's different from that cash. So we're going to have 1,030 that we're paying to Ferguson, and if you look at it, the two add up to the 1,050. So those are the journal entries there. Let's go in. Let me clear that drawing. If we bought the $1,000 of goods on 1/26 and we needed to return of them and still 2% net 30, we come in on January 30th and let's say some of those goods were bad. We want to send back $200 worth of goods. Well, initially when we bought them on the 26th, we had it into accounts payable, right? So do we still owe the $200 on accounts payable if we return those goods? No. So we need to come in and reduce our accounts payable for Ferguson by $200. And we need to come in and show purchase, returns, and allowances of $200. Then if we come in on January 31st and we are making payment, you have to think about, whoa, that was a bad T account. You have to think about what is in that T account for accounts payable. We had 1,000 over here. We returned 200. What's left? $800, right? So that's the AP. So when we look at this, our balance for accounts payable is 800. So when we make our payment, we're going to have accounts payable for Ferguson of 800. And we're going to come in and have a purchase discount. And we're going to have cash, right? And our discount is 2% of 800. And I have to do the math on that because I don't have that in my head. I like even numbers. 800 times. So the discount's $16 when you multiply those out. So we've got $16 there, and that would be what, 788? No, 780. Okay, see, math in my head is not good. 800, 784. That's it, right? Okay, so $784. So these two add up to the 800. And that would be your payment after you've made that purchase, returns, and allowances. Okay, so now we come in, that's pretty much everything you're going to have on the periodic side. Now let's come in and talk about perpetual. So under perpetual inventory, you're going to keep up every time there's a sale, you're in turn going to record cost of goods sold. And we're going to have a continuous inventory balance. So we're not going to use a purchase account. We're going to use, your book may call it merchandise inventory, or it may just call it inventory, and we're going to have an account called cost of goods sold when we make the sale of those items. So this is when we buy items, everything goes into our inventory account, which is an asset. So how do you increase an asset? With a debit, right? And how do you decrease an asset? With a credit. Cost of goods sold is a cost account, so it goes in like an expense. So how do you increase cost of goods sold? With a debit. And how do you decrease it? With a credit. So it's like our fives. Okay, so when we go in and make a purchase, now this is, we're not going to worry about the recording of the sale. We're recording our purchase of inventory to sell at a later date. So on 1/26, if we buy again the $1,000 from Mr. Ferguson, instead of using the purchase account, now we're directly going to put it into our inventory. So we're still going to come in, oh, wrong account. We're still going to come in and have accounts payable. Why is it not? We're still going to have accounts payable in here. And we're going to have our inventory account of merchandise inventory. So merchandise inventory, 1,000, and accounts payable for Ferguson, 1,000. If we return goods, let's say on 1/30, we're going to return $200 worth of goods. Under the perpetual inventory system, we directly affect inventory. So essentially on the return, so when we make a return, we flip the journal entry we previously made. We got to reduce our accounts payable by $200, and we're going to reduce our inventory account by $200. And I'm going to abbreviate it inventory instead of merchandise inventory. It's just a little bit shorter. It's the same account. So that's when we make a return. And then if we have to make payment on January 31st, you got to think about what is left in your inventory account. You started out, or your accounts payable, you started out with 1,000. We returned 200. So what's left? $800. So when we make that payment, whatever went on the books, we got to take it off the books. So we've got 800, and we're going to pay cash 800. So that's when we make payment. So let's come in now and talk about making these journal entries with freight. So let's keep using our $1,000, 210 net 30, and our freight is, let's go with $50 again. So that's our product. Now, if we have FOB shipping, that means we are responsible for the freight and we have to pay the $50. If it's FOB destination, we do not have the shipping that we have to pay. Okay, so 1/26, we are buying $1,000. Let's assume shipping point, so I'm going to put an S there for shipping. And the seller is going to incorporate that shipping cost in our invoice. Now under perpetual, let me write that up, perpetual, we include all of our shipping costs that we have to pay into our inventory account. Under periodic, you separate it out from purchases and freight in. But under perpetual, it all goes into the same. So we're all going to put it into inventory. So we're going to put the 1,050 in there, and we're going to put accounts payable 1,050. If it is destination on that same day, our inventory would be 1,000 because the seller is responsible for paying for the shipping, and we only owe the $1,000. So that's the difference between shipping point and destination. Now, when you come in and make that discount under perpetual, because we included all of it into our inventory account, you don't have to worry about separating that out. Discount works the same. Well, you don't really have a. Let me see if they're doing. Let me stop that share. I gotta remember, different textbooks do different things. So let me see. I know how I teach it in principles. We just tell them the discount's calculated based on what their invoice was. And I hate to tell you guys wrong. So this is what they're telling you when you journalize. You have under perpetual, it all goes into that cost of goods sold. So when you record the transactions, that's what they're telling you. They're going to use merchandise inventory and accounts payable. If it's not talking about freight, you still calculate the discount the same way. Returns and allowances, like I said, you flip the journal entry. When you record the purchase discount, they didn't talk about, okay, when you record the purchase discount, it goes in and reduces the inventory account. So instead of doing purchase discounts, it just offsets to inventory. What do they want you to do on freight? They're going to call it freight out. Ugh, okay. I'm not a fan of that, but that's what this book wants you to do. So that's what they're going to have you do on homework. So if the freight is paid by the seller, it could be recording as an operating expense on the seller. If it's paid by the buyer, it's going to be added to the merchandise inventory. So that's what they're showing you here. It's added to your inventory. Maybe you have to pay it to FedEx by themselves, and you just put it in there as cash, and it all goes to your inventory account. I think they're going to keep it simple on you, and they're not going to talk about calculating returns and allowances on that freight like they did in periodic, so don't worry about it. When you come in and do a discount or return, you're just going to calculate it based off the invoice that you had. That's a problem. Different authors kind of do things. There's usually some standard procedures that we use. But I find different authors like to use different account titles, and what I would use sometimes is different. So I try to make it what the book's going to have so you guys can match up to it. So let me go back, and let's go back to this in here. We'll do some journal entries. Okay, so under perpetual, let's just ignore the shipping and let's just talk about returns. So we're going to say a return. If we make a return of $200 on our 1,000 that we have, we, like I said, essentially have to flip that journal entry. We're going to reduce our accounts payable to $100, and we're going to reduce our inventory by $200, and not worry about the shipping and everything. I'm trying to think if there's anything else. You've got returns. You have your discounts when you make payment on that. It would essentially be 131. We pay the inventory if we owed the 1,050. You would essentially do accounts payable 1,050, and you would pay cash 1,050. Perpetual is a little bit less complicated. You don't have all those extra accounts. It all goes into inventory. If you did have the payment and a return, then you just subtract that out, whatever was left. So it'd be 850 instead of 1,050. If you were in your discount period, then you just calculate the discount like you would the other way. Okay. Hopefully, the other thing that the chapter talks about is a debit memorandum. I think you guys are okay with that. It's a debit memorandum under the periodic system because it's going into purchase returns and allowances, versus on the sales side, it's a credit memorandum. You know how we talked about accounts receivable has all these amounts in it, right? And then you can have a sub-account, subsidiary ledger, where it has all of your AR for every individual account. That was back from chapter 9. And the sums of all of those tie into the main AR account, right? Well, same thing on AP. You have one master AP account, and then you have your sub ledger over here, where you're going to have all your vendors that you owe money to, and you're going to keep up with their balances, and whatever their amounts are all tie into the main AP account. So that is chapter 10 in a nutshell, and hopefully maybe you guys like the whiteboard instead of just kind of flipping through the book and looking at journal entries, and you can hear me talk through some examples. I'll do some other videos for homework problems if you guys get questions about it, but hopefully that gives you a good summary. So, key factors to look at. You need to know what type of inventory system you're in, because under perpetual you're going to have inventory. Under periodic, your counts are going to be purchases, purchase, returns and allowances, and purchase discounts. So it matters in your journal entries which system you're in, so keep that in mind.